We'll be going over IRS Form 8824, like-kind exchanges, and Section 1043, conflict of interest sales. So most of the time, taxpayers who would use this form would be involved in something called a Section 1031 exchange. In a Section 1031 exchange is a part of the Internal Revenue Code that allows taxpayers to defer the capital gain on the sale of real estate if, as a part of that sale, the proceeds are used to reinvest in a similar type of property. So, for example, under 1031, this would be exchanging real estate. You can defer the capital gain on the sale of an investment property, such as, let's say, a duplex, and you decide to invest that money into an apartment building. Since you're exchanging like-kind properties, you can do a like-kind exchange, which would defer your tax liability to at some point in the future when you sell the replacement property. But then you also have to report the information on this on IRS Form 8824. And that way you can keep a running tab on things like how much capital gains did you defer? What's the adjusted basis in your new property? Did you actually realize or recognize any capital gains during the transaction? And sometimes there can be a lot of complexity to what normally could look like a straightforward transaction. So this form is designed to report most of that information, and it also contains some things that not all payers will be using. So this is a 2-page tax form with 4 parts. Part 1, most taxpayers will fill this out. This is the information on the like-kind exchange. Part 2, related party exchange information. So you would only use Part 2 if there's a related party that you did this transaction with, and in which case there are certain rules that you must follow. Part 3 is the realized gain or loss, the recognized gain, and then the basis of any like-kind property that you received. And finally, Part 4, we'll go through this part briefly and lightly, but it's only used by certain officers or employees, either within the federal executive branch or judicial officers of the federal government. This might be Supreme Court justices, tax court judges, appeals court judges, so on and so forth. Basically, if they are required to sell a certain property under Section 1043, and they are able to defer the gain of certain properties under conflict of interest sales if the cost of the replacement property is more than the basis of the divested property. So we'll walk through this, but the vast majority of taxpayers will not use Part 4. Now let's go up to the top where we started already filling in this tax form on behalf of our hero, John Smith. We've entered his identifying number in the top right-hand corner. Now the form instructions specifically state that lines 1 and 2 should only be used to describe real property being, like real estate. So in line 1, we just wrote a generic description, single family house, and then the address of the property that we gave up, and then the description of the property that we received. So in John's case, we exchanged a single family house for a single family house down the street, and entering the dates of transactions. So when did we acquire the original property. I just put in that we acquired it January 1st of 2020, and then we transferred that property to the other party on June 30th, 2022. Now, under the like-kind exchange rules, or under Section 1031 rules, you have a 45-day requirement in which you must have a written identification on your replacement property. You don't need to have actually secured the replacement property within 45 days, but you do have to have it identified in writing. And then you have up to 180 days to close on the eventual property. So then in line 6, the date that we actually received that like-kind property from the other party. And again, if you actually receive the property within the 45-day window, then for all intents and purposes, you have met the written identification requirement. So, and then line 7, you're going to check yes or no if you made the exchange with a related party. So it does not matter if you went through an intermediary, like a qualified Section 1031 intermediary or not. So, but if you did go do this with a related party, then you would have to enter related party exchange information. You can still do a 1031 exchange, you just need to follow certain rules. And then if not, then you can go directly to Part 3. And for most taxpayers, if you did not do a Section 1031 exchange with a related party, you're only going to be filling out Parts 1 and Parts 3. So in Part 2, we'll just write in the name of the related party. We're going to, I already checked no, but we'll go through the mechanics of Part 2 as if we had selected yes. So a related party can be anyone that is a relative, father, mother, grandparent, grandchildren, brother, sister. It can also be a closely held entity, so an S corporation, a partnership, trust, estate, nonprofit even. So anytime you have a related party, it is one of those definitions. You can get the formal definition in the form instructions. So there are two key questions. During the tax year and then before the date, that's 2 years after the last transfer of property, did the related party sell or dispose any part of the property that you transferred to them? And then line 10 is, during this tax year, did you sell or dispose of any part of the like-kind property that you received as part of the transaction? So basically it's saying as long as both parties hold on to the property for at least 2 years after the final transfer, then you can go to Part 3. So if both lines 9 and 10 are no, and this was the year of the exchange, then you'll have to go to Part 3 to calculate your realized gain, loss, recognized gain, and then basis of any property that you received. If both lines 9 and 10 are no, and this was not the year of the exchange, then you stop here. If either line 9 or 910 is yes, then you have to complete Part 3 and then report any deferred gain or loss unless an exception on line 11 applies. So for intents and purposes, we'll just select no for here, but then there are 3 exceptions. One, the disposition being after the death of one of the related parties. 2, the disposition was an involuntary conversion and the threat of conversion happened after the exchange took place. Or 3, you can establish to the IRS's satisfaction that neither the exchange nor the eventual disposition of the property had tax avoidance as one of its primary purposes. So you'll need to attach a written explanation, and most likely you'll need to have your tax professional help you come up with some sort of a justification that meets the IRS guidelines for satisfaction. And there are certain certain criteria that you can find in the form instructions that would indicate, if you can truthfully say things of that nature, then the IRS will be satisfied that your primary purpose was not tax avoidance. So again, the IRS always takes a position that tax avoidance shouldn't be the primary reason for constructing a transaction, right? So there are times that you can have a transaction where you're deferring the gain, but if you're doing this as part of a shell game and the transaction should have had tax implications and you're just trying to squeeze this in through a loophole, the IRS does reserve the right to evaluate this on the merits and then disallow the tax treatment that would have been allowable if this was not a related party exchange. So part 3, this is where you calculate either realized gain or loss, your recognized gain, and then the basis of like-kind property received. So in lines 12, 13, and 14, you're only going to complete those if you gave up property that was not like-kind. So if you throw in cash or if you throw in a car that isn't like-kind property, then you would enter that information here. We're going to just pretend, for intents and purposes, that our hero, John Smith, just traded a house for a house. So in this case, we did not give up any other property, and we don't need to report the gain of that. Now, if the property that you gave up was used previously as a home, you might be able to exclude that income under Section 121, sale of your primary residence. So the form instructions have a little bit more information about that. So in line 15, you're going to enter the amount of cash that you received, the fair market value of other property that you received, plus any other net liabilities that the other party assumed, like if they took over mortgages, things of that nature. And this is reduced by any exchange expenses that you might have incurred, such as transaction costs or closing costs. You can't reduce this down below 0, but this basically is known in the Section 1031 world as boot. So it's other consideration that you would have received as part of the sale, and this may come into play when it comes to recognizing any gains. So it's important to recognize that what you might have received. So we're just going to say that our hero received $10,000 in cash, and then we traded. Our house was worth $200,000, and we're going to add lines 15 and 16. So now that's the new house, right? So if we had an adjusted basis of the like-kind property that we gave up, And we'll just say that, John's basis in his old house was $100,000. So subtracting line 18 from line 17, so that means the realized gain is $110,000. So this basically is saying if his old house, if his old investment property had a $100,000 adjusted basis, and then he received $210,000 in terms of the new house plus a little bit of cash on top. So his realized gain is $110,000. In line 20, you're going to enter the smaller of line 15 or line 19, but this cannot be less than 0. So we go back to the boot number, which is $10,000. Now, if you didn't receive any boot, this would be 0, and you would enter 0. So now, ordinary income under recapture rules. If we had to recapture any deferred income based on the sale of business property, we would enter that amount here. However, for this example, we're going to say that there was none. So basically, we're going to subtract line 21 from line 20, and that gives us a total of $10,000. Then we're going to add lines 21 and 22. This is our recognized gain. So basically, we realized a gain of $110,000. However, we received $10,000 in boot. So we have to recognize the $10,000 gain. That's going to go onto our tax return. The other $100,000, we can defer that. And that's the exact calculation we're going to do right here, is the $100,000 that we're subtracting from line 19, the difference between $110,000 and the $10,000, that results in our deferred gain of $100,000. Now we're going to add lines 18 and 23 to get, so that's 110 plus 10, that's $100,000 plus $10,000. Then we're going to subtract line 15. This is the new basis of the property. So kind of lines up with the adjusted basis of the property that we gave up. Since we got $110,000 and we're recognizing the tax bill for the $10,000 in boot that we received, then it makes sense that we carried forward the $100,000 basis that we already had. Okay. So in part 4, again, you're only going to be completing this if you're forced to sell a house under Section 1043 conflict of interest rules. So unless you're a Supreme Court justice or a high-ranking member of, the federal judiciary or the federal executive branch, you're probably not going to be completing this part of the form. If you have a certificate of divestiture, you would enter the number on the upper right-hand corner of that form in line 26. You don't need to attach a copy of your certificate. Just keep it in your records in case you're audited. And then your description of the divested property and the description of the replacement property should look very similar to your property descriptions right here. So and then you would enter the date that you the divested property was sold. You would enter the sales price of the divested property, the basis of the divested property. So your realized gain is the difference of those two. Now, if you are divesting a property under conflict of interest rules, you can replace that property within 60 days of the date of sale. And if you did do that, then you would enter the new replacement cost here. So subtracting line 30 from line 33 from line 30, you would get 0. If you had ordinary income that was subject to recapture, you would enter that here and on IRS Form 4797, which is the sale of business property form. The IRS form instructions contain additional information for that. And then you would subtract your ordinary income from line 34. In this case, it would be 0 or less. If it's more than 0, that means you have a gain of some sort. So you may have to enter it on IRS Form 4797. If it's a capital gain, you would enter it on Schedule D of your income tax return. If you invested in a qualified opportunity fund, then you would also report on IRS Form 8997, which is the qualified opportunity fund report. You would add lines 35 and 36 and subtract that total from line 32. And then you would subtract line 37 from the line 33 number. And this is your basis of your replacement property. So again, most taxpayers will never see Part 4. And if you do see Part 4, you're likely going to have your tax preparer complete this on your behalf. When you're done with this form, you would submit it with your income tax return for the year that you're reporting. So that's all we have for this form. If you are interested in reading more detail about it, you can check out our article, which is on our website. Simply go to teachmepersonalfinance.com, type in IRS Form 8824 in the search bar, and you should see this article appear. If you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And if you have any questions, as always, please feel free to post them in the comment section or send me an email. Thank you very much and have a great day.